Recession.
Recession.
That's all everybody's talking about on social media and every financial news outlet. And if you're wondering how we got here,
We did it, Joe.
Recessions suck, but if you're an investor, they're usually not as bad as you would think.
I'm not worried at all.
We're going to shine a little bit of light on the situation so you can come out on top and possibly turn this into an opportunity of a lifetime.
to give you guys a little bit of perspective, since World War II, the average length of a recession is only about 11 months. We saw a little bit of everything from virus outbreaks to natural disasters and even flash crashes.
Now we're sitting down 875 points.
The Dow Jones Industrial Average dropped more than 900 points.
Even throughout the ups and downs between 1980 and 2019, the S&P 500 averaged about a 14% return. Now, this doesn't guarantee future results, but it does show us that those who invested for the long term got heavily rewarded.
Now, we didn't want this video to be like every other buy the dip video. So we got ourselves a shovel and dug a little deeper to figure out the best assets to invest in for higher returns while still mitigating some of that risk.
We dug up this chart that shows asset class returns from 2007 to 2021, and in the top three, we have REITs that have returned 195%, small caps with a return of 249%, and large cap companies with a staggering 357% return.
With that information in mind, let's focus on large cap companies as they've performed the best over the last 15 years span.
Large caps are the giants, the soaring behemoths with a market cap of over $10 billion, and you can find some of the best in the S&P 500 index.
We didn't stop there though. We wanted to find a sector within the S&P that's been hit hard year to date, and according to CSImarket.com, the tech sector is definitely one of them.
Here's the kicker though. The info tech sector has performed the best in the last 15 years with an average return of over 16%. That's a total return of 938%. Not bad if you ask me.
So to recap, we're looking to invest in large cap companies within the tech sector that have been beaten down like Johnny Depp after a late night with Amber Heard. You heard?
History has shown that markets crash on the regular and always bounce back over time, so the goal here is to take advantage of these stocks while they're down. Are they at their bottoms? Probably not, but that's why we're keeping a close eye on them.
You want to make sure with any company you invest in that it has strong financials, but you can't forget one of the most important things, which is the company's future and if you believe in it.
So let's go over 3 large cap tech stocks that we believe in and are going to keep an eye on in this market, starting with Nvidia. Year to date, the stock has fallen around 40%, and in this market, it could likely fall even further.
They do have healthy financials with good revenue and earnings and enough cash flow to cover their debt, but that's not why we're so bullish on this company though.
When you hear the name Nvidia, you probably think graphic cards for gaming. And while that's true, they're also working on so much more. Things like autonomous machines, robotics, and even AI.
If you don't think these innovative techs will be huge in the future, take a look at this. According to Precedence Research, the AI market is about $100 billion right now, and in 8 years, it's projected to be around $1.5 trillion. No big deal.
They're also going full throttle on autonomous driving with their NVIDIA Drive platform, which covers everything from the car to the data center.
Not sold on self-driving vehicles either? Check this out. Precedence Research expects autonomous vehicle market to grow by over 1,300% in the next 8 years. We're talking about a future $1 trillion industry here, ladies and gentlemen.
These are just a few of the reasons that we like this company for the long term, but don't take our word for it. Go to their website, browse around and see for yourself. You might be surprised. To make it easy, we'll even leave you guys a link in the description.
The next stock we're keeping an eye on claims that over 90% of the world's creative professionals use their product, and the product is Photoshop, and the company is Adobe, which is down around 30% so far this year and continues to slip despite having fairly sound financials.
The revenue and earnings are consistent, but the best part is they keep a nice war chest of cash on hand to cover their liabilities. Aside from their financials though, here's why we like the company long term. Max?
Every single day, we watch vids that are edited on Premiere or look at photos edited on Photoshop or Lightroom. And of course, we can't leave out the impact of PDFs over the last 2 decades.
Listen to this, an estimated 300 billion PDFs were opened in Adobe last year, and they've processed over 8 billion electronic and digital signatures. The days of using paper are coming to an end, which will only benefit Adobe.
Bottom line, Adobe's products have a stranglehold on the creative market. Once again, check them out for yourself.
This last stock is one that some investors love and others love to hate. We're talking about Tesla, which is down around 40% this year, and they continue to get a bad rap for being overvalued, especially with their massive price to earnings ratio.
Despite all that, the company continues to dominate the competition. Tesla has not only outperformed the EV market, but even the combustion engine vehicles in similar classes. And it isn't even close.
A big reason they're so successful is their vertical integration production model. Basically, they keep as much of the engineering and production in-house, from coding their own software right down to developing and producing their own batteries.
This keeps them from relying on other companies, and it's paid off big time with all the supply chain issues. The proof is in the pudding because their competition continues to copy their business model.
Tesla is also expanding their charging footprint and commercial energy, building factories around the world, and even working on a humanoid robot. This is a company that continues to innovate and think outside of the box, and we're down with that.
If you're more of an ETF investor, we got you. Here's a few options that focus on large cap tech stocks like the SPDR Tech Select Sector ETF, ticker XLK. Of course, this tracks the tech sector of the S&P 500.
You can also check out the Invesco S&P 500 Equal Weight Tech ETF, ticker RYT. This index has equally weighted stocks in the infotech sector of the S&P.
And lastly, Old Faithful, the Vanguard Information Technology Index Fund, ticker VGT, which follows the tech sector of the S&P as well. Of course, all of these ETFs have some of the biggest names in tech and are all down around 25 to 30% this year.
We gotta stress that all of the stocks and ETFs that we've mentioned could still dump further because we don't know if we're in a recession, if we're going in a recession, or if this could be the worst recession of our lives.
Either way, recessions can have a range of negative effects on our lives that we need to be aware of. Economic activity will slow down, people will lose their jobs and businesses, but the worst part is when people start losing their homes like we saw in 2008.
It's not all doom and gloom though if you're prepared for it, and in fact, many people become wealthy during recessions. Here's a quick checklist of things to have in order before investing, especially in volatile markets like these. Max?
Obviously, one of the most important things to have during a recession is a stable job. This is your income generating machine. So if it's unstable, find a secure one or put yourself in a better situation.
From there, clear any bad debt. These are things like credit cards, payday loans, or even car loans.
Ain't nobody got time for that.
Then you're gonna wanna boost your emergency fund. Typically 3 to 6 months is recommended, but it wouldn't hurt to add a couple extra months for added security.
If you have problems saving, prioritize your purchases as needs versus wants and live below your means. This means no vanilla lattes or lottery tickets.
If you have all these things in order, congratulations. You're likely better off than many.
With wild markets like we're seeing today, let us know what your strategy is in the comments below.
And be careful out there. It's crazy.